Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This is part 19 of my 19-part series that I conducted where I looked at the various sectors as reported by FactSet. And this is last, you normally would say last but not least, but frankly I think this might be about the least sector, at least that I'm personally interested in. I only found 5 utility stocks that I was willing to even feature in this article. Any of the ones that I really like, the really good ones, and I'll give a sneak peek at that a little later, I feel are overvalued now. So what I've got here, these are all electric utilities, number one. I don't have any of the water utilities or some of the other types of utilities that I mentioned in the written part. I've got 2 in the United States, 1 in the United Kingdom, and 2 in Canada. They're all very high quality companies with the exception of Edison International, which is their kind of a low investment grade. Otherwise, the other 4 are A- rated. So let's go ahead and take a look at the 5 utilities that I selected here to review for you. And let me show you some of the attributes that I actually don't like about utility stocks. First and foremost, utility stocks tend to be low growth entities. You can see here that the long-term growth rate of National Grid, which is the United Kingdom company, the orange line represents earnings. One of the things that's really important here, when you run a fast graph on a company like this, I want you to notice how you instantly can see a lot about what type of company it is, how well it's been managed, how fast it's been able to grow, and you also see this incredible correlation with price and earnings. Price in the long run clearly goes where the company's earnings go. Now the white line on this graph is the dividend history, and they did pay a special dividend in 2010. The company has a March fiscal year. Otherwise, they've had several periods where they've cut their dividend. The reason I mention all this, when you look at this statistically, the PE ratio is 14.5. That's the blended PE. That looks attractive. The dividend yield is 5.7%. That appears to be very attractive. The company's A- rated, only has 48% debt. So if you're looking at it statistically, it looks great. But looking at it over the long run, it's not the kind of company I'm interested in. I don't trust the fact that my dividends will be consistent. Now, when I measure the performance of the dividends, the average growth has been 10%. The compound average growth has been 4.5%. And the reason there's such a divergence there is because you've got periods where they cut their dividend by rather substantial amounts, like 2011, 2009, 2016, and 17, where they had these, rather large, 2015, large cuts in dividend. But yet, having said that, because of the high yield, if you compare this to, let's say, the average company in the market, which I talked about quite a bit in the article, it generated, significantly more dividend income than the S&P. It did not produce as much growth as the S&P, but ironically, it came out at almost a perfect dead heat or slight outperformance of the S&P, again, because it threw off so much dividend income. That's a plus with this company, with the one exception being that you just don't really trust what the dividend income is going to be from one year to the next. And a lot of that high yield has to do with the special dividend they paid. So these things, when you just look at things statistically, they can be misleading. I don't like what I see in forecasting going forward very much. Again, it's one of the few companies that's technically fairly valued, but it has very, very little growth. It's actually forecast to grow at a minus 1.8% going forward. The next company I'm looking at is Edison International. And let's start with the historical graph, because this really, I'm going to get rid of some of this anomalous growth here. If you look at this company over a reasonably long period of time, I'm going back to 2006 here, you can see its, earnings growth is very flat, averaging about 3% a year. I want you to notice that, again, price kind of goes where the earnings go. The company over this time frame does have a good dividend record. Average growth is about 7%, 6.9 compound average. It's been very consistently raising their dividend, but it does it at different rates. Performance-wise, it outperformed the S&P on dividend income over this time frame, significantly underperformed it, by the way, on a growth. Annualized rate of return without dividends was about 2.6% versus 6.6% for the S&P over this time frame. Came in at 4.8% annualized versus 7.7%, but it did generate slightly more dividend income. The key of utility stocks is the amount of income they generate more than anything else. So that's Edison International. Not crazy about investing in a company with those kind of long-term results. The next next example I have here is PPL. And if you look at PPL, again, you see a record here that to me is not really desirable. You had some pretty good growth coming into the 2001 recession. Then you've had really flatness going on, if you will. If you look at the growth rate here, it's averaging about 1.2%. The company is traded somewhere around a 13 PE. Its fair value PE would be about 11, offers a 5% yield. It's A- rated with 60% debt. But once again, when you look at these stocks, you'll see that they don't really generate a lot of performance, but oftentimes you'll see utilities generating significantly more income than the S&P. But they will underperform often on a total return. My point again is a 13 PE, a 5% dividend yield, A- rating company looks pretty attractive at first glance. But again, when you look at the broader picture, I think you get a slightly different perspective. My next example here is, I guess it's pronounced ATCO Limited. It's a Toronto Stock Exchange or a Canadian-based company. This is kind of an interesting utility for the Canadian company. Valuation is attractive now, but not undervalued. It normally trades at around 13 times earnings. It's trading at about 14.5. Has a 3.6% dividend yield, but this one does give us some growth. It offers about a 6.5% growth rate. It started this time frame undervalued relative to the blue line and ended it slightly overvalued. So I'm expecting growth to be a little higher than 6.5%. So let's take a look. When I get down here and look at performance, the growth is 9%. That's the earnings growth of, roughly 6.5% plus the premium or the PE ratio expansion I showed a moment ago. Generated double the income of the S&P 500, and the total return was 10.6% annualized, turning 10,000 into 47,000 versus 10,000 turning into 33,000. So when you get a good income producing stock that has a little bit of growth, you can get more income than you can out of the average stock, and you can also get some additional growth. So this one looks pretty decent from that point of view. My next and final example is another Canadian company, relatively new utility, just went public in 2015. You can see it came out at a high valuation, and the price has kind of, reverted to the mean, so to speak. Earnings growth, once again, 2%, A- rated, offers a 4.2% dividend yield. And because of the high valuation, the performance here was actually negative on a standpoint of growth. A $10,000 investment would have actually shrunk to $9,716. That's about breaking even, or less than a 1% annualized loss. But it only generated a 2.5% rate of return. It did outproduce the S&P on dividends, even as a result of its high valuation. But the point is, it's moving more back into alignment with fair value, and the analysts are looking at, and there are 12 analysts that are looking at 2020 out to 2020 that do expect this stock to grow at about 4% a year going forward, a little bit faster than historical. But once again, that still doesn't give you great rates of return. Does offer a nice dividend yield, is A- rated, but again, I'm not a big fan of owning utilities other than maybe to park cash or to utilize them as a bond alternative in some cases if the yield is high enough. Now, there are exceptions to every rule, and so let's take a look at a couple of my favorite utilities. I briefly mentioned them in the article. This is one that I just recently sold. This is NextEra Energy. If I was going to invest in a utility, it would be one that had these attributes. You notice it has very strong growth, 7.5%. I want you to notice that up through 2013, the price tracked earnings at around a 15 PE ratio very consistently. Then we've had this separation and this overvaluation, and that leads to a relatively low dividend yield for a utility stock. It is A- rated with only 40% debt. Now, the performance over this time frame has been exceptional. It dramatically outperformed the S&P on dividend income. It dramatically outperformed the S&P on growth. But it's done that as a result of being significantly overvalued. And the reason I didn't feature this in the article, this whole series was about finding attractive valuations. This stock doesn't have attractive valuation currently. When I look going forward, growth is expected to maintain that 7 to 8% growth that we saw historically. But once again, if we get a reversion to the mean, and this goes back to a more normal 15 PE ratio like we saw for all these years or lower, you could have some significant stress, at least in the short run, on investing in NextEra Energy here. I think it's a great holding, but it's not necessarily one that I would say is investable today. And then last but not least, let's take a look at another favorite of mine, which is WEC Energy, or Wisconsin Energy. And you see almost an identical picture that we saw with Next Era Energy. You see a tremendous growth, averaging slightly less than we saw with Next Era, which is really the old Florida Power and Light, by the way. Here we have 6.7% growth. We had normal valuations at around 15 times earnings, and then we've had this disconnect and this really high overvaluation. But again, long-term performance, or performance since 2002, has dramatically produced more dividend income than the S&P. It's produced significantly more growth than the S&P and a significantly higher total return than the S&P. But again, it's a function of, back in 2002, when I show this particular time frame, the PE was 11. Now the PE ratio is 23. So you've had this tremendous PE expansion coupled with this, earnings growth of 6.7%. Has a great dividend record. Dividend growth has averaged about 11% a year, which is really extraordinary. I love this utility, but I can't see investing in it at these high valuations because the earnings yield here is really quite low. If I look at the earnings yield, it's under 5%, and I'm looking for earnings yield of at least 6.5% to 7%. Anyway, this is my last and final review of the 19 sectors of individual stocks reported by FactSet. From here on, I'll be looking at individual stocks and kind of being a little more comprehensive with looking at the inner workings of each individual company. I tend to do one company at a time. I've enjoyed this series. I hope you have. I find it difficult to cover this many companies in one sitting, but I wanted to give you a broad perspective that it is a market of stocks and not a stock market. It's Chuck Harneveld saying thanks for watching.